About 11 months ago, I released a video discussing what's called the trending value strategy. I'll take you through the specifics, but just to set the context, the 25 stocks I listed in that video as a portfolio have delivered an annualized gain of 96.9%. To put that into perspective, the Nifty 50 gained about 30% during the same period. The Midcap 150 index saw a 52% increase. Factor funds like Momentum and Alpha did a lot better. The Nifty 50 delivered a solid 82%, and while some sectoral indices, especially the Nifty PSE index, did cross the 90% mark, none of these indices could surpass the 96.9% return that the trending value strategy generated. I'll get into the specifics in just a minute, but first let's squash the bull market में 97% लाने में क्या skill है वाला argument. Now, in simple numbers, this particular strategy has been outperforming the broader market index by a good 10% in not 1, not 2, not 3, not 10, but remarkably, the trending value strategy has outperformed the market index for over 45 years. I'll come to India specific numbers as well, but between 1964 and 2009, the strategy delivered annualized returns of 21.1%, while the S&P 500 delivered a sedate 9.5%. In actual money, $10,000 invested at the beginning of 1964 would have turned into just over $69 million, illustrating the power of the strategy. I personally hold the trending value strategy in high regard, much like some of the other strategies on my channel, as it brings with it a unique perspective to investing and a structured way to significantly outperform the market. So grab a pen and paper, give me your undivided attention, and by the end of this video, we should have built an updated and promising trending value portfolio for ourselves. Let's begin. The concept of trending value was first put forth by James O'Shaughnessy in his book What Works on Wall Street. And as you might have guessed, there are two key elements to this strategy: trending and value. Trending refers to momentum, a word you've heard me say dozens of times in the last couple of years, which simply denotes those stocks that are already showing an upward price movement that is catching the market's attention. You can quickly extract this list by tapping on Basic and Pro filters, then under Price and Volume, click on 6-month returns, then do a descending order sort, and that's it. You'll have a long list of stocks that have performed well in the past 6 months, indicating built-in price momentum. The second part of a puzzle is value, and our objective here is to identify fundamentally strong yet undervalued companies that the market hasn't fully recognized yet. There's a methodology for this as well, but if one looks at the bigger picture, what we are essentially doing with this strategy is to maximize the potential of both momentum investing and value investing. In fact, O'Shaughnessy explained it well in his book when he backtested data over 45 years to find that if one had invested in the S&P index, annual returns would have been about 11.2%. A momentum-only strategy would have yielded an yearly return of 14.5%. Buying only undervalued stocks using O'Shaughnessy's Value Composite 2 indicator, which we'll learn in just a minute, would have resulted in an annualized return of 17.3%. However, a combination of value and momentum, that is, the trending value strategy, would have achieved an average yearly return of 21.2% over that 45-year period. If all this sounds impressive to you, let's dive into the details of constructing a trending value strategy. For this, I'll be using Tickertape, the sponsors of today's video, and a comprehensive stock analysis platform with a variety of useful tools, including a powerful screener to help you create custom screens or explore pre-built ones like dividend gems, cash-rich small caps, and even one featuring momentum monsters. Tickertape also offers a comprehensive portfolio tracker that updates your stock, mutual fund, and gold investments automatically, giving decisive insights like your diversification score, XIRR analysis, forecast, red flag alerts, and much more. For every company, there's an impressive scorecard offering valuable information across key parameters such as the stock's performance, valuation, growth potential, profitability, and optimal entry point. Another standout is Tickertape's Market Mover feature that helps you track the week's largest deals, see what popular investors are buying and selling, and even spot what promoters are doing with their shareholding. There's so much more to explore on Tickertape, and while some of these advanced tools are a part of the Pro plan, here's the good news. As a special bonus for my viewers, Tickertape is offering an exclusive 40% discount on the Pro plan for a limited time period. While signing up, just use the code in this video's description and get ready to unlock a host of powerful tools that will make your investing a lot smarter. Right, now it all starts with the calculation of a value score, which is the combination of 6 different metrics. The P ratio, which is simply the current market price per share divided by the earnings per share, and understandably, the lower this is, the better. Then there's the price to book ratio, which is very useful for capital intensive businesses. Again, lower is better. The third metric is price to cash flow from operations, and here too, a lower number makes the business a lot more attractive. Next is price to sales, which is O'Shaughnessy's favorite metric, and once again, lower is better. Number 5 is my favorite metric, the EV to EBITDA ratio, where the enterprise value is simply the market cap plus the net debt, which is then divided by the EBITDA, earnings before interest, taxes, depreciation, and amortization. And here again, a lower number is always preferable. And the sixth and final variable when calculating the value score is the dividend yield. And in this case, a higher number is more favorable. Okay, now that we understand the theory of it, here's how we calculate the value composite score. Step 1 is to define the universe, and because we need a large yet relevant base, I've selected only those companies with at least 500 crores in market cap, which on Tickertape yielded me some 1,860 odd companies. But after removing some ETF entries, the final list came to exactly 1,840 companies. Please note this 500 crores criteria is just a judgment call from my end, so if you want to try out a different number, feel free to do so. Step 2 is to extract the 6 metrics we just discussed, and all 6 can be found under the valuation filter, making this part super easy. Step 3 is to download this information on a worksheet, so simply click on the export button, convert the CSV into an Excel sheet. But if you're feeling lazy doing this, then you can also use the worksheet I've already prepared that's attached in the video's description. Okay, step 4 is the most important part, so listen up closely. Now, this is where we have to allocate a decile for every company across all 6 metrics. Like in the case of the P ratio, and since we have 1,840 entries, this comes to 184 entries per decile, which means the lowest 184 entries in terms of its P is allocated decile 1. The next 184 entries, so rank number 185 to 368 is decile 2. 369 until 552 is decile 3, and so on. On a stock basis, and as an example, Hindustan Petroleum HPCL with a PE multiple of 5.8 is ranked 26th in my list, and because it lies between 1 and 184, HPCL is assigned the first decile and is therefore awarded a single point in our value composite score calculations. Similarly, Infosys with a P multiple of 30 is assigned the 4th decile, while Dixon Technologies with a P ratio of 228 currently receives 9 points per our computation table. In fact, I should mention this Raymond Lifestyle Limited, which was spun off and got listed just last month, is a company I had covered in issue 12 of my newsletter. I bring this up because while it says here a P of 6.6, per my calculations, the multiple is much higher, and the correct picture is likely to emerge only when the company declares its Q2 financial results either this month or in November. Nevertheless, because every screener is essentially a system, there are likely to be some cracks, which is why doing sanity checks is important, as I did in this case by allocating all negative P ratio companies a decile of 10, so 10 points each. The next step, step 5, is to replicate the decile allocating exercise that I did with the P ratio across the remaining 5 variables. And if one does it right, then you too should have an Excel sheet just like this one here. Please note, irrespective of the screening platform you use, not every data point will be available. So in the 2-3% cases where there was a blank, or if the ratio was negative, I chose to assign the 10th decile to such companies so that it doesn't skew our analysis. You can understand this better from my worksheet, but my point is some cleanup will be required, but I'm sure you've guessed it by now. A score of 1 means that the company is undervalued on that particular parameter, and as the score goes higher, 7, 8, 9, 10, it means the company is getting more expensive from a valuation perspective. As an example, look at Indian Oil Corporation, which is placed in the top decile for all 6 metrics, making it super undervalued as per our trending value methodology. While at the other extreme is a company like Vari Technologies, which for all 6 parameters is on the 10th decile. And this brings us to the last step, step 6, which is to add up decile scores across all 6 metrics, which gives us a cumulative value score for every company. So in the case of Indian Oil Corporation, along with ONGC and Kama Holdings, wherein it was the first decile for all parameters, this comes to a total of 6, which is the lowest one can go. Apollo Tyres is packed with a lot of 2 and 3 decile scores, which gives it a cumulative score of 13, while Apollo Hospitals finds itself at the higher end of the value score spectrum, indicating that this company is a bit overvalued currently. But you know what's not overvalued in these times? It's definitely my weekly investing newsletter. In fact, I'll say it's grossly undervalued as I feature some exciting and potentially profitable investing stories, including Sami Hotel's remarkable turnaround post their IPO, BLS International's revenue surge following their acquisition in Turkey, Zaggle's impressive growth and international ambitions, Sky Gold's continued rise fueled by lower gold prices and increasing consumer demand, and of course, there's the story on Raymond Lifestyle and how its recent demerger has created a potential mispricing opportunity for contrarian investors. All this is a lot of research, a lot of reading, but it's all worth it when we see these ideas translate into real profits. If you haven't subscribed to my newsletter, then kindly do so now and also tell your friends about it. Part 2 in our implementation of the trending value strategy is to arrive at the momentum score, and very simply, we're looking for companies whose stock price has performed well in the recent past. So again, I'll go back to the Tickertape screener, add filter. Under price and volume, I tap on 6-month return, and there we go. The stock price return of the past 6 months is made available to us, which I'll export in a CSV and map it to a revised Excel sheet. Please note there's no specific rule in O'Shaughnessy's book that only 6 months of momentum has to be used. And if you're comfortable with a little bit of volatility and a bit more work, you can even try a 3 or a 4-month cycle. Anyways, I'll be using 6 months here. That is, stocks whose price have risen the most in the past 6 months. But before extracting that data, it's important to reduce our universe to only those companies that are in the top decile as per their combined value scores. So in our case, the top decile is 1,840 companies divided by 10. So say the top 180, 190 companies, which essentially means a value score ranging from 6 until 18. We then sort this truncated list in descending order based on which stocks gave the best price return in the past 6 months. And from here, the top 25 stocks are chosen, and these 25 stocks is what comprises our trending value portfolio. From the top, there is Nava Limited, which is into ferroalloys. Nandan Denims, I've never heard of this company. Vedanta, everyone knows Vedanta. Rane Holdings, which is into auto parts. Padamji Paper Products, Ratan India Power Limited, etc. And this, ladies and gentlemen, is my October 2024 version of the trending value strategy. Now notice the scores here. There are a lot of 14, 15, 16 and 18s in our 25 stock list, which tells us that even if a stock displays amazing value like what IOCL, ONGC and Kama Holdings were showing per the value composite score, momentum is also an important variable, and some of the more middling companies in this 14 to 18 range are the ones that have done very well lately. All said and done, each of these stocks do display value characteristics in terms of a low P ratio, a low PB ratio, attractive price to sales, etc. But there are some additional points one needs to consider when implementing the strategy, so let's examine those as well. Okay, let's start with the number of stocks, and while we have taken it at 25, this number could have been 50 as well. To address this how many stocks quandary, O'Shaughnessy did a lot of backtesting, and one of the results of those experiments is a 25 stock portfolio generally gives the highest risk adjusted portfolio returns, so we'll stick to 25 in this case. A second point that often comes up is on when to sell. Actually, when to sell is not the right question. It's more like when should one rebalance one's portfolio, and ideally this activity should be taken up on a semi-annual basis. However, if you're going in for a more aggressive approach, then quarterly rebalancing can also be effective. In terms of how to rebalance, we do the same exercise I walked you through earlier in this video. That is, pull out a list of companies with a market cap of over 500 crores from a service like Tickertape, extract the values around our 6 metrics: the P ratio, PB ratio, price to cash flow from operations, price to sales, EV to EBITDA, and the dividend yield. Compute the combined value score, extract a subset of the first deciles. Number 5, combine this with momentum metrics, finalize a list of 25 stocks, sell the underperformers from the older list, that is stocks that have fallen out of the top decile, and replace them with new top ranking stocks. And remember, this should all be done with equal weighting. So if you're investing 25,000 rupees, then that's 1,000 rupees per stock. Another key aspect to understand is the type of companies this trending value strategy typically identifies. Now, we already know most of these stocks are at the lower end of the valuation metrics, which is good, but I was pleasantly surprised to find that most of these stocks had an ROC, a return on capital employed, of over 18, which indicates that these companies are efficiently using the capital to generate profits. In other words, our value stocks are now a bit more valuable, and this gives me that slight assurance that these stocks are not likely to fall into a value trap. In fact, I did another check, and just to get some external validation, I even used some of Tickertape's special filters. For instance, there's this value momentum score which seems very close to what we have done here today. And for most of our stock picks, this was in the 70s, 80s, or 90s. Higher this number, the better it is. And something similar was seen when I populated the fundamental score, another of Tickertape's proprietary filters, with many of our trending value stocks coming out with a respectable number there. Of course, we don't want to complicate matters by stuffing in too many variables, but if you're keen on getting that slight edge, then do explore subscribing to Tickertape's Pro membership plan that comes at some 200 rupees a month. And if you want it cheaper, of course, you want it cheaper, then do apply my code that's available in the description below. Point blank, trending value works. And I'm not just saying this because I achieved 96% returns on last year's picks, but that's also what the team at Capital Mind derived when they backtested the trending value strategy on Indian stocks over a 16-year time frame, that is from 2007 until 2023. Very quickly, their study showed that trending value tends to be more of a small cap strategy, which is in line with our own list, where almost 90% of the stocks are either small or micro in terms of market cap. Secondly, and in terms of numbers, the Capital Mind study showed a CAGR of 20.6% over a 16-year period, while the Nifty 50 delivered only 9.9% during that same period, giving us a 10% alpha that's similar to what O'Shaughnessy found in his own study. The team also looked at rolling returns over a 10-year period, and the data consistently showed outperformance compared to the Nifty 50. But yes, one negative of this strategy, which even I observed when studying my stocks from last year, is the higher level of portfolio volatility, which is understandable given the high exposure to small cap and micro cap companies. So there will always be some good and bad in every strategy, but as it stands, the trending value strategy has done well in many markets all around the world, and it's certainly something you should understand and keep as a part of your investing toolkit. I sincerely hope you found this video informative. Do press the like button, share this video with your friends, do subscribe to my newsletter, and I'll see you very soon. Until then.